Hello, this is Kevin Prince from BMO Exchange Traded Funds, and I just want to say welcome back to the Market Insights webinar. Appreciate you taking the time in your schedules to join us again today to get some education and some insights in the overall market. And as we say on the show on a regular basis, is that really this show has been built upon you and your insights in the marketplace that you're asking for. So I'd like to thank everybody who took the time and effort and sent us a question in advance, because that kind of stuff not only helps in the existing webinar we're doing, but also helps form the content we develop over time, because we want to make sure this is really meeting your needs for these market times. So looking forward to diving the topic today. What we're going to do today is talk about the industry flows in around ETFs and try to get you some insights in regards towards that, where the flows are going. Plus, we want to give you some market commentary too, to really give you take a look at some stuff that maybe you not normally see and look a little bit underneath the hood there too. So let's get into it. Let me start off, of course, with a standard disclaimer. Disclaimer is really saying to you that we're not providing advice today, and effectively, we're not providing recommendations, but we're really trying to provide you some insights into the overall market itself. And with that, let's get started across the board with our guest speakers. Mackenzie Box is joining us again. Thank you, Mackenzie. Glad to have you back. And then in addition to that, we're going to bring in our strategist around ETFs, Alfred Lee, and he's going to give some market commentary. So we're going to have Mackenzie cover off the flows and where the money's moving in the industry right now and give you some insights there, and then have Alfred, of course, dive in a little more detail and some market commentary. And of course, as we always know, we're going to finish off with the number of questions that came in, and we're going to do our best to answer those specific questions. With that, let's get started. Mackenzie, there's a report that we pushed out from BMO ETFs, I think the beginning of the month, talking about the year semi-annual flows. And some pretty good insights on that. Maybe you can quickly touch base around that as we move through where the money's been flowing in the industry for the last 6 months.
Yeah, thanks, Kevin, and thanks everyone for joining today. The ETF industry in Canada has had a record-breaking year, and I think with markets shifting rapidly in response to COVID-19 and increased monetary stimulus put forth by the governments, investors have started to turn more to ETFs to navigate the market, and I think they're recognizing the benefits of ETFs through, easy to use single ticket solutions, recognizing their trading efficiency, diversification, and transparency. So I think because of that, we've had record-breaking flows thus far this year, and I really like this graphic here on the slide. Looking at the dark blue line, that represents the flows for the first half of the year, and the lighter blue representing the later half. So if you look at 2020 thus far, you can see that we've already shattered records for flows for this year. So 22.4 billion, which is driven primarily from equities, which accounted for roughly 15 billion, and fixed income accounting for just over 5 billion. So we've had a great start to the year, and I think we'll continue to see flows going towards ETFs given market volatility.
Well, it's also nice to see that the industry itself continues to build and build and build year over year. And these are not just BMO flows, the overall industry flows when it comes to ETFs. So that's also a good sign for the industry itself. But wow, look at the growth so far this year. Yeah. Now, Mackenzie, that was the first 6 months. Of course, another month has passed. So let's jump into overall flows and conversation around flows. Let's first talk about the volume itself, because there's net assets, which you just showed, because the net assets are growing. But in addition to net assets is kind of the two-way flow that goes back and forth. And maybe give you some insights around that.
Yeah, sure. Yeah, sure. And I think total equities are the dominant part of the market, and ETFs are always going to participate and move with the market. So just looking at the red line, that's the volume of trading the ETFs relatively to the marketplace. And if you look along here, you can kind of see that during the contraction or during the correction of the market, ETFs were played pretty heavy. And now that things have come off a little bit, we're starting to see things normalize a little bit. So when trading volumes were at the highest, we saw ETFs participate in that. And now they've kind of moved back to normal ranges. And, people are shifting to likely some single stock exposures as well.
Makes a lot of sense. When people are trying to put that trade on quickly, that liquid ETF, kind of showcases an easy way to put that trade on, whether you want to grab a broad market or a certain sector. And yeah, more stabilizing now when it comes to flow, watching that green line kind of cascade back into the more normal range. Let's take a look now, Mackenzie, specifically company perspective, asset perspective, and dive in a little bit of detail in regards to flows from the beginning part of the year. And again, thanks to National for their research for this.
Yeah, so here's a quick snapshot of the ETF providers in Canada. So currently there are 36 providers, and I think, each month we see more products coming to market, and we've also seen a lot of new providers come to market in the last couple of years too. So this number continues to grow, but just looking at the chart, you can really see the dominant players in the industry, and BMO and iShares really stand out there. And during the correction, we saw a lot of these flows go into, the top 4-5 providers, if you will. And I think that's something you see kind of across the board. So not just in the Canadian marketplace, but also in the US. A lot of times these bigger providers get the largest flows because they have a broad product lineup, quality products, higher trading volume. So naturally, you see more money flowing into those providers. But just looking and highlighting here, you can see for this year, BMO ETFs and iShares are really leading the charge. We're actually just ahead, building on our 9 years of being #1 in net new flows. So we're on track for that this year as well.
Thanks for that. And it's just interesting for someone to take a look at the scale of the Canadian ETF industry as it cascades down across the board. Let's jump into a little bit of a viewpoint on, not just the company perspective, but actually where the flows are going when it comes to, asset classes.
Yeah, and I mentioned it earlier, but equities still are kind of the main attributor to flows, and we often see most of the money going there. Fixed income, you're also seeing a large amount of money going there as well. And I think we mentioned this on one of our previous webinars, but I think when you look at fixed income ETFs, that further exemplifies the benefits of ETFs for transparency, liquidity. So we are seeing a lot of the flows go directly to equities and fixed income. People are looking for opportunity and want to take advantage of the market, and then fixed income where people are looking for that protection. I would say too, we're also seeing a little bit more flows into the multi-asset. So thinking back to our session from last week, so some of the asset allocation ETFs that are relatively new to the market, we are seeing more flows pick up there as people look towards single ticket solutions. Just of note, our ETFs, the ones that we spoke about last week, ZCon, ZGRO, and ZBAL, and just in one quarter, they're up 15% based on flow. So we are starting to see people shift more towards those one-ticket solutions as well.
Yeah, certainly a good diversification as you add that to your portfolio across the board. Hey, quickly also to the commodities, is that basically more of the gold trade, right? If I saw that?
Yes, right? and I think, yeah, and you're going to see that kind of uptick, especially in the recent months, as we've seen a lot of people allocating towards gold.
So let's go down even a little bit further, because we're certainly seeing the flows, and it's basically a diversified mix with a little more tilt towards commodities than normal. And let's take a look at underneath the hood a bit here, the geographical mix plus the sector mix across the board, kind of give people a little more insights of where this money's been flowing to get them thinking about their own portfolio construction.
Yeah, so looking at the top graph, you can see Canada and US really being the dominant players of where money's going. Canada slightly trailing behind the US, but that's really a common theme we'd see, as a lot of people have a home bias, and allocate majority of their funds towards, Canada or the US. So that's kind of across the industry. We are seeing quite a bit of pickup in developed markets as well, that being more of an institutional trade. So thinking markets like EFI. So we've seen quite a lot of flows into our EFI ETF, which is ZEA. And then just rounding down to table 16 here, we've also seen money flow into different sectors. So, and this is an interesting thing to look at throughout the year. Banks, the yields are strong, so we're seeing a lot of people allocate towards banks, materials, real estate. We're hearing a lot about healthcare. So I think people are looking at these as complements to their portfolio, and given the markets, I think people are finding complements to their portfolio or maybe tilting towards a particular sector where they see opportunity. And then just shifting to table 17 on the slide here, we're seeing a lot of the money going into cap weighted, but we are seeing money go elsewhere too, into, your dividend and low vol ETFs, as well as thematic. So thinking like your ESG. Again, I think this is a lot of investors looking for complements to their portfolio or tilting their portfolio if they're looking for that additional income through dividend, or they want to be, they want that low vol exposure as well.
Well, thanks, Avik. It's definitely it's interesting to also see the flows in the bottom of the chart there of technology and energy. Those are, technology shows from its strength, and energy, maybe coming back a little bit, I guess, and people are starting to see that and executing that thought process through ETFs across the board. That's a good snapshot of one more thing. Then maybe talk about fixed income too, for that matter. Because we covered the equity piece. Let's make sure we dive a little more detail on the fixed income side too, if we can.
Yeah, and again, broad market. Again, you're going to see majority of the flow. So the Canadian aggregate. So simply looking at ZAG or XBB, these are the top performing mandates in fixed income. Consistently strong performance, at 8 basis points. They're a solid performer and a great addition to portfolio. We're also seeing a lot of flow into the cash alternative. And I think what that's really indicating is, there's cash on the sideline. People are waiting to deploy some of their money. And then we're also seeing global, quite a bit of flows there, but I think that's broadly attributed to institutional flows in this space.
That's some pretty good insight there too, especially when you think of the broad market. I think when you see in the broad market, I think people are understanding that, diversification really matters in this marketplace. Having a little bit of different credit qualities and different term structure makes sense. And then to your point, having interesting to see the cash on the sideline starting to build up, even within the ETF space itself specifically. That's some pretty good insights to the flows itself, and I think it also helps people understand where the money's going to. And more recently, as you look at your portfolio construction, I'm going to shift gears here. I'm going to bring Alfred into it, because Alfred runs some strategies for us, and actually is our strategist at BMO ETFs. And he looks at different perspectives in the marketplace. But I think let's start off the backdrop there, if we can, Alfred, is maybe a little about the economy, and more specifically of, we all know about the unemployment rate being high. Maybe we can start off there and give us that backdrop, and maybe why people are pushing money into certain flows. And then also, as we move through these ones, start to think about where positioning people might think about going forward as we go through it. So let's start off with the market itself.
Sure, thanks, Kevin. And I think this is a common question that comes up. I think a lot of people are asking, why the markets continue to rally, especially when the economic backdrop, especially when you look at unemployment. Unemployment right now is running at 13%, both in the U.S. and Canada. So this is the highest level we've seen in Canada since 1982, and the highest level on record in the U.S. as well. So a lot of people are just wondering, why are we seeing the markets rally? So when you look at the S&P 500, we basically are at, the February kind of pre-COVID levels at this point. The TSX is a little bit further behind, but, if we keep trending at this level, it certainly feels like the TSX will get there within a couple of months. But overall, I think a lot of people they have been pricing in an ultimate disaster scenario. We think, over the short term, at least for the top portion, the markets are going to behave more like, it's almost like they're viewing this as a natural disaster. I think what a lot of people are focused on right now is basically the jobless numbers. And the way I would characterize this is basically, there's a number of different types of job losses. There's ones that are temporary. So think of, restaurant workers that are coming back online right now as the economy opens up. But then there's certainly economies or industries that are, that have been changed forever. So corporate real estate, work from home being a good example of that. So that's going to change forever. And then you have jobs, that are going to be lost forever. As you see consolidation in certain industries. So I think what we're seeing right now is basically a lot of those jobless numbers are giving positive surprises just because, a lot of those temporary jobs are coming back online. So that ultimately will, that momentum of positive surprises in the jobless numbers will eventually, that momentum will eventually fade. But ultimately, I think the big question is, why are the markets continuing to rally? And, overall, it's because, central banks for sure have been providing liquidity. But I think, as I mentioned before, as some of these temporary jobs come back online, the focus is going to shift more towards, about those permanent changes in industries and so on and so forth. So, right now, if you look at the market and you look at kind of the underlying relationships in the market, it's pretty interesting because you look at, the kind of the relationships in the market right now. What we're finding right now is that, the lower quality assets, which have performed well off of the market bottom. So in March and April, those are starting to fade now. And what we're starting to see is, higher quality assets start to outperform. So, in the last couple of months, it was more about, it wasn't so much about, which part of the market you owned. It was more about, whether you own the market or not. But I think going forward, it's going to be more important in terms of, which part of the market are you owning? Which exposure do you have to the market? So I think, going forward, as we head into Q3, people have to be a little bit more selective in terms of, which part of the market they own. And I think the beauty of the ETF is that it allows investors to, quickly recharacterize their portfolio and efficiently get access to, different style factors such as low volatility, quality, and different sectors within the economy as well.
So Alfred, let's get into that. I mean, because I think you're right. I mean, there's a certain number of things that I like your report you produce, and for me and the team is that you start to look at things to watch for across the board. And one of the things you're watching off the bat is that volatility, VIX structure itself. Maybe give the insights to the listeners here too about what you're looking at, what you're thinking about when it comes to volatility in the coming future.
Yeah, sure. So I think a lot of people, when they try to gauge, what's the sentiment in the market, are people being fearful or is the market calm? They generally point towards the VIX, which, is a measure of volatility in the market. That's an important measure, but it's also important to see, where the future of volatility is being priced in. So that's essentially looking at the VIX term structure. So essentially what that tells you is, where's the market gauging volatility in 1 month, 2 months, 3 months, and et cetera. So if you look at the term structure of the VIX, that essentially tells you what the market is expecting for volatility in the future. So in this chart over here, what you'll notice is that you see this peak in October, and what the market is anticipating at this point is basically volatility, or we're going to eventually run into some speed bumps. And the reason why is because, if you think about November, what we have then is, the U.S. presidential elections in October. We also have, 1 month of kids going back to school, which also means back to work for a lot of people as well. So potentially another wave of coronavirus. So overall, that's why we're seeing the market anticipate, volatility in Q3. So again, just going back to my point before, I think, going forward, it just matters. It's going to matter more in terms of, which part of the market you own. So I think, some things that people want to consider is that if volatility is going up, it's always good to think about, defensive exposures in your portfolio. So, do you have exposure to low volatility? Do you have exposure to quality? And then also, I think one thing that often gets overlooked in the recent market is bonds. So I think with yields where they are right now, a lot of people say, why do I own bonds, or why do I need to own bonds? I could just get, yield through dividend-paying stocks, which have a much higher yield and are more tax efficient as well. But the reason why is because, bonds provide this negative correlation to risk assets such as equities, credit, and so on and so forth. So government bonds are also, even though they don't yield much at this time, from a portfolio construction point of view, government bonds do play a very critical role in terms of building a sound portfolio.
And of course, I think too, if you look at it and maybe get your thoughts on it, if you think volatility is going to rise, there are products out there that do benefit from rising volatility, like cover calls and products that use derivative-based structures in there as a way to enhance income across the board. So that's also something that people can factor in the future if they want that exposure, of course. Alfred, let's talk about, you certainly did take a look at where the market was moving when it comes to respective beta. And beta, bear with everybody here, beta is just a measurement of volatility across the board. So market volatility itself specifically. You've seen beta, of course, come up and start to move slightly more down. Maybe give some insight about that and why you're watching that specifically.
Yeah, so as you mentioned, beta is basically a measure of a stock's sensitivity to market movement. So a stock that has a higher beta is going to be more volatile than the market, and something that has a lower beta, of course, means that it's going to be less volatile than the market. And why I think this is important is because, typically when you come off of a market trough, so coming off of market bottom, typically the high beta stocks tend to outperform. But as that kind of rally progresses and kind of matures, what you find is that lower beta stocks start to take over. So we're already starting to see that, where, that outperformance in higher beta stocks is already starting to fade. So I think, over the next couple of months, low volatility, which tended to be very in vogue over the last decade, I think, low volatility, there's still a good long-term case for low volatility, because I think, if you look at demographics, for example, you have aging demographics around the world, which tends to be where most of the investable assets are. So because of that, you have this kind of wide-scale de-risking. And then when you look at kind of how, risk behaves over the last decade, I would say after 2008, the amount of risk that you take isn't really rewarded anymore. Back in 2008, it was almost like risk and reward was more of a linear relationship. But because we have this aging demographic now, in many cases, that relationship between risk and reward is not a linear kind of relationship anymore, where certain times when you take on too much risk, it's also very detrimental to a portfolio. So, again, we think in this kind of environment, low volatility certainly is well positioned, just because we have that trend in aging demographics. And again, I think with the innovation that we've seen in the ETF world over the last 10 years, ETFs are a good vehicle, not only in getting exposure to traditional kind of market cap weighted products, but also different style factors, and low volatility being a good example of that.
Thanks for that, Alfred. Good thing to watch. Volatility is coming down a bit, but then how to access it across the board, but specifically the volatility in regards towards higher beta versus lower beta. Alfred, certainly some things else you've been watching on, and of course, I think a lot of listeners here certainly follow it too, is the trend when it comes to gold prices. It came off more recently, for that matter too. So maybe give us a little insight of what you're watching when it comes to gold across the board. And you've got a chart here on spot gold and on equity gold, for that matter.
Yeah, so gold is, once again, it's very topical, right? It's almost like gold becomes very topical every 10 years or so, but it certainly has its own cycle, and that's what we're seeing right now. Gold recently broke above $2,000, and then consolidated back down to $1,900. So there's been a lot of questions in terms of, is the run in gold over? But, from our point of view, it's basically, when gold hit 2000, there was a lot of what we call technical selling at that point. Think about it this way, is that a lot of people that were early on in the trade in gold bought it at a lower level, but mentally they have a price pegged into their head saying that, when gold hits $2,000, I'm going to start selling, or at least take some profits and reduce my position in gold. And that's essentially what we're seeing at this point. We're seeing some consolidation, but overall, I think, when you look at the reasons why you want to own gold, gold is essentially a hedge against, three different risk factors. It's a hedge against macroeconomic risk. It's a hedge against U.S. dollar. It's a hedge against inflation as well. So overall, when you look at, the macro risk is certainly fading at this point. But U.S. dollar continues to weaken at this point. There's no inflation on record technically, but we are seeing some wide-scale debasement with currency. So, if you look at the longer-term trends in gold, you see central banks kind of diversifying away from U.S. dollars right now by buying gold. So we've seen that trend with a lot of central banks. But also, as I mentioned before, you see a lot of currency debasement right now, right? So you see not only the U.S. dollar dropping, but all kind of other currencies dropping as well. So, central banks right now, they are increasing their balance sheet, which increases the monetary supply and circulation. So technically, you could argue that, the price of gold isn't going up. It's almost like a fixed rate, but the prices of all currencies are going down. So it looks like gold is going up. So overall, there's a lot of questions in terms of, whether you should get your exposure to gold in gold bullion or gold stocks, and which one is better. It really depends, right? So I would say, gold bullion, if you're looking at it from a portfolio construction point of view, gold bullion is certainly better because it's going to be negatively correlated. But if you're bullish on gold, and if you believe gold prices will continue to go up, then gold stocks, I would argue, is a better, is more fitting for that point of view because, think about it this way: a gold company essentially mines for gold right now, but they're selling gold in the future. So if you think, or if the market believes gold prices are going up to $2,500, and that's a hypothetical price, and gold is at $2,000 right now, they're mining gold right now, but they're selling it at $2,500, or the market is pricing in a future price of $2,500. So by investing in gold stocks, you're getting that inherent leverage through the operational, balance sheet of those gold companies. So there is a difference between, how to get your exposure to gold, and they certainly have different pros and cons.
Thanks for that, Alfred. Let's also take a look at, you've been watching China, specifically around the A shares and the resurgence around there. Now, maybe a lot of listeners don't know what A shares are. Give us a little background on that, and then what you're specifically looking at there.
Yeah, so, there's, Chinese stocks are a little bit different just because, the Chinese economy is closed. So for, people in the mainland and inside China, they invest in A shares, which are the locally listed shares. However, there are, certain Chinese companies that list on the Hong Kong exchange, for example, that is open to the rest of the world. Those are called H shares. And then there's also American Depository Receipts, or ADRs. Those are essentially listed on the U.S. exchanges, but they all provide exposure to Chinese companies. So in many cases, some companies have both A shares and H shares, and maybe ADRs as well. So what we look at is we basically look at the relationship between those companies that have stocks listed in both A shares and H shares as well. And what we've noticed is that the A shares have rallied, whereas the H shares have not. So ADRs, I would say, trade more in line with H shares. So, a lot of people are kind of, becoming a little bit more bullish on China at this point. So I think, when you want to get exposure to China, just, do your due diligence in terms of knowing how you're going to get that exposure. But I would argue, going through H shares and ADRs they're trading at a discount right now relative to the H shares. So that's potentially, potentially a more efficient way to get it if you believe that A shares have rallied too much relative to H shares and ADR. So I would say most of the ETFs listed in North America tend to get their exposure through ADRs and H shares. There are a few that do get exposure through A shares, but of course, before you make any investment, always look under the hood and know how that ETF is getting that exposure.
Thanks for that, Alfred. And what we'll quickly do here, because you want to get to a couple questions, but I really want to highlight one thing that you tend to look at is kind of the good, the bad, and the ugly of the marketplace. Maybe just give you one or two thoughts, please, on what you think of the good, what's good in the market right now that you're liking, maybe what's bad kind of stuff you're kind of watching, and ugly, what you're really kind of put on your hot list.
So, why don't I just break it down to, the macro, fundamental, and technical, and we'll give our views in each of those very quickly. So, with the macroeconomic backdrop, I think right now is very good. But heading into Q3, as I mentioned before, with the U.S. presidential election, COVID potentially a second wave, right now, the macroeconomic backdrop is good and improving. But come Q3, we potentially have this binary effect where it could get really good or it could get, a little bit worse. So, it really depends on those two events and how those play out. From a technical perspective, we're watching a number of relationships in the market right now. So low vol to high beta, quality stocks to the S&P 500 and investment grade bonds versus high yield bonds as well. What we're noticing is that, a lot of higher quality assets are starting to outperform now. So that essentially tells us that, a lot of the easy gains that we're seeing in the market, as we saw in, March and April of this year, those easy gains are essentially gone. So again, investors have to be a little bit more selective and look at, higher quality assets at this point as well. From a fundamental perspective, I would say, valuations, they're getting a little bit rich at this point. But again, if you look at things from a price to earnings perspective, it's really tough to gauge still in terms of knowing where earnings are for certain companies. It's really tough to gauge, where valuations are right now. So, overall, we would argue that if you are looking at fundamentals and valuations of companies, just make sure, one way to play this is if you don't know where the earnings are, just invest in higher quality assets. And if you have those companies that do have competitive advantages in their fields, over the long haul, you would think that, that's certainly a good way to play this market.
Well, thanks for that, Alfred. I appreciate your thoughts. Now we're going to shift gears from here. I appreciate both you and Mackenzie giving us both where the market flows have been, and that, of course, some views about positioning on a go-forward basis. As always, we have a bunch of questions that came in. We're going to have to go through just a few this time because we went a little longer. But that being said, let me see if we can answer just a couple off this one, and we're going to save the other ones for next week. No problem. First and foremost, maybe I'll bring Alfred in this one, and I'll tackle the first part. I might use you for the second part there, Alfred. Really, like, how does currency hedging work is really the first question. Because you have these ETFs in Canada that hedge out the movement of the currency. So when you look at a security out there, Apple being a good example, the key thing to think about with those kind of stocks is that you have a position in Apple itself, of course, but inherently, because it's priced in US dollars, you also have a position in the US dollars. Now, what do Canadian ETF providers do? We effectively mitigate that position in the US dollars and just leave behind the position for you in the company itself. So your call, of course, across the board, whether you're hedged or unhedged, but really what the hedged ETF is mitigating the movement of the currency, leaving behind just the equity. Now, Alfred, to you, certainly taking a look at the marketplace, where would one position himself, or there's things to think about when it comes to Canada versus US dollars, specifically maybe around the S&P itself, the S&P 500?
So there's a number of things you should be looking for, but overall, I would say, I would start off by saying that, what the kind of objective of the various kind of currency formats is that, to your point, when you invest in an ETF that tracks the S&P 500 without a currency hedge, you're taking on both the stock exposure and also the currency exposure as well. So you have to consider, how that US dollar is going to perform relative to Canadian dollars. A hedged ETF allows an investor to invest in the US market as if they're a US investor. So the point of a currency hedged ETF is that it's supposed to allow you to not, worry about currency. It's supposed to allow you to invest in the local market as if you are a local investor. But, it really depends on, what an investor is looking for. So if they don't want to deal with currency, I would say currency hedging is the better choice. However, if they are bullish about the US and if they are bullish about the US dollar, going without the currency hedge is a better option. I would say right now, just because there's a lot of uncertainty in the US dollar. We have seen a lot of investors move into the currency hedge format and not have to worry about that noise in currency, not have to worry about what they're going to do with their monetary policy and what's going to go on with the US elections as well. So a lot of people have moved towards currency hedge, and that's certainly a good way to play it.
Thanks for that, Alfred. We have time for just one more. So we'll probably close off on gold here, if you don't mind. Certainly adding gold, but just kind of get more perspective here on gold stocks versus gold bullion. And then in platinum, maybe not go to the platinum piece, but just simply talk about, thoughts on gold versus gold bullion, gold miners versus gold bullion.
Yeah. So as I mentioned before, I think, it really depends on, what you're trying to, what your objective is. If you're trying to build a portfolio that is well diversified, I would argue that gold bullion is a better way to look at it. However, if you are bullish on gold, I would say gold companies is, the better way to play it. As I mentioned before, I think, when you invest in gold companies, you have to, the market essentially prices in the future price of gold. One thing I would say is that, during a market sell-off, if we do see a wide-scale deleveraging event, as we saw in March of this year, as we saw in 2008, gold stocks behave more like stocks during a sell-off. Coming off of the market bottom, as gold prices start to rally, however, that's when you start to see gold stocks outperform. But one caveat is that, again, during a market sell-off, gold equities behave like equities.
Thanks for that, Alfred, and thanks for that, Mackenzie, too. Sorry we couldn't get to all the questions today. Don't worry, we're going to save them. We're going to answer them next week, no problem whatsoever. And feel free to please, if you have more questions on the market or more questions you want insights around ETFs, please send them in, because again, it helps us build this content for this show specifically for you. That's about as much time we have today. I'm going to say thank you for joining us. I'll let you know next week. We're going to spend time talking about alternatives in the marketplace. And if you think about that, what is that? You have equities, you have fixed income. Well, really an alternative is another way of complementing your portfolio and really more diversifying your portfolio. Certainly becoming a lot more of a bigger discussion nowadays. So we're going to spend some time next 2 shows and dive into alternatives as a way to complement your portfolio. Look forward to joining you next week, Friday at 1 o'clock, August 21st. Have yourself a good week ahead. Cheers.